In this short video, let's see how and why the Silicon Valley Bank failed. So first we see the basics on how the banks earn money. So the first avenue is the spread. Spread is basically the difference between the amount of money paid for interest which is to be paid. For example, for a person who has deposited the money in the bank, we have to pay some interest, and the interest we earn. So for example, if we have loaned the money to a borrower, so the bank must be earning more money from the borrowed capital. So the difference in the earning from the borrowed interest comparison to the deposited interest money which has to be paid, that is the spread. The higher the spread, the more the money the banks are going to earn. The second avenue is the service charges. So be it the banking services for which the bank charges money, be it the wealth management, investment services. So for whatever services the bank is providing, they charge something. So that is the second avenue of earning money. The third one, which is very, very important for the story, is the investing surplus. So whatever surplus money the bank is having, how it is going to invest that. And when it invests it invests in the good faith that it is going to earn good money out of the investments. So that is the investing surplus. And that's where the problem happened for this bank. Again, some more key terms. So liquidity crisis. If the bank cannot pay, it does not have enough liquid money, enough cash available, it cannot pay the money to the depositors. It is called liquidity crisis. Insolvency. Insolvency is when the bank is in bad shape, meaning that the debts are more than the equity. Debts are basically more than the assets. So which means the bank is going on the route of bankruptcy. So assets are less and the liabilities are more. That is insolvency. Run on a bank. If lot of depositors come to the bank to withdraw their funds, this is called run on the money. Run on the bank. Sorry. So why run on the bank happens? So if in case there is a bad news about a bank, very bad grave news about the bank, the depositors are worried about their capital invested on the bank, then they must withdraw that, and that is what happens in this case. We will see in a bit. So before we go any further, let's see some details on the SVB bank. So the Silicon Valley Bank was the 16th largest bank before it failed on 10th March. It was founded around 20 years back. Now this is very important that the bank's customers were really rich businesses, startups primarily, and wealthy individuals. And as per the bank, they reported that 65% it was catering to the 65% of US startups. Now the trouble. There was between 2020 and 2021, there was a significant inflow of cash. From 62, it became 124 billion cash. This cash had to be converted to gains and had to be invested somewhere. And what the bank did was it invested in long-term treasury bonds at that point of time. So that point of time, the interest rates were low and the interest on a long-term treasury bond was also low. And now as we see, the Feds have increased interest a lot, and thereby the value of these treasury bond becoming very, very less. And this is basically coming very clearly. It came very clearly in their accounting, wherein the mark to market accounting gave a realistic picture of unrealized losses in excess of 15 billion. And this 15 billion is such a huge money. Even though this is unrealized loss, so unless they are really going to sell these bonds, they are not going to realize this loss. So it is on paper. But what happened is, this next thing is what is basically the precursor to the ultimate fall, wherein what is happening is the continued interest hikes, and the startups started to withdraw the funds. And to raise this fund, the bank had to sold its available securities, and when they sold the securities, they had realized 1.8 billion of loss. And this news did not go well. It did not go well, and it further complicated the situation. So 8th of March, the SVP announced measures to increase deposits. And At the same time, in spite of it taking all these measures to increase deposit, and the Moody's still downgraded the bank. The subsequently what happened is that the venture capitalist firms asked their clientele to withdraw the funds from the bank, and this is what led to a major run on the bank, wherein 42 billion dollars USDs were withdrawn from the bank on 9th of March. And then the inevitable, the doom happened on the 10th of March, and FDIC took control of the bank on 10th of March. So this is what happens for this bank. There are some uh, there are two aspects to it. One is, was the bank really at fault? Seeing the situation way back in 2020 and today, the kind of interest has risen. It may not have understood all the things, but the other mistake, the big mistake probably is that putting all the eggs in one basket, putting every money in the treasury bonds, and that too at for a very long period of time, which cannot be you cannot capitalize them immediately if the need arises. So that's another thing. The third thing is that this ask from the VCs to withdraw the fund. I mean, this is also a very big issue. They could have waited for some time. The bank could have still managed. They were trying to manage things. So they could have managed the things, but nobody knows for sure whether that would have been managed by the bank. Yeah, but these are just speculations which we can make. But this collapse happened, and this is the sequence of topology of events which led to the ultimate collapse. Okay, thank you very much.